Hey everyone, welcome back to Corporate Decoder, the place where we uncover the secrets buried deep within company reports. If you thought blank check companies were done after the SPAC boom, well, get ready because we have a real doozy from Integrated Wellness Acquisition Corp, today's scroll form 10. Q quarterly report pursuant to Section 13 or 15 of the Securities Exchange Act of 1934. Scroll, this is a quarterly report for the period ending the 30th of September, 2025, and it is packed with the kind of details that make you question everything you thought you knew about SPACs. It is a roller coaster of numbers, and if you are looking for clarity, this report might just be the opposite. So buckle up before we dive in if you love getting these quick insights into the financial world. Make sure you are subscribed and hit that notification bell. We also have a fantastic community over on Discord, all linked in the description below, where you can discuss these findings and more. Let's start with the balance sheet, a snapshot of what the company owns and owes as of the 30th of September this year. Total assets are just over $15 million. But here is the kicker, almost all of that $15 million is tied up in restricted cash and cash held in the trust account. This is typical for a SPAC that has not yet completed its business combination. The company is basically holding on to its investor money, waiting for a deal. On the other side of the balance sheet, we see liabilities, and here is where things get a bit more interesting. Total current liabilities stand at about $8.6 million with accrued expenses, making up a significant chunk of that. This includes things like fees for services rendered. Looking further down, we see a deferred underwriter's fee payable of over $4 million. Now, for the really interesting part, Class A ordinary shares subject to possible redemption. These shares are presented as a liability because the holders have the right to redeem them for cash in certain situations. As of the 30th of September, the redemption value for these shares is over $15 million. This clearly shows how much money is essentially spoken for and waiting to be returned to shareholders if the deal doesn't go through. Moving on to the statement of operations, the company's profit and loss statement. This is where we see how much money the company is spending and earning, and spoiler alert, for a SPAC that has not yet completed a business combination, it is mostly spending money. For the 3 months ending the 30th of September, 2025 operating expenses were over $420,000, and for the 9 months of the year, they've spent over $960,000. This is primarily driven by formation and operating costs along with accounting and legal expenses. This is the cost of being a public company while searching for a deal. Unsurprisingly, the company shows a net loss for both the 3 and 9 month periods ending the 30th of September. 2025, the net loss for the 3 months was around $302,000, and for the 9 months it was nearly $620,000. But here is something to keep in mind: these numbers are offset by about $118,000 and $347,000 respectively from interest earned on the cash held in that trusty trust account. So while they are spending money, they are also earning a little bit on the money they are holding onto. On the per share basis, the basic and diluted net income or loss for the redeemable Class A ordinary shares is shown. This is a bit of a mouthful, but it basically tells us how much income or loss is attributable to each of those redeemable shares for the 3 months ending the 30th of September. 2025, it is about 9 cents per share, and for the 9 months, it is 34 cents per share. Now, for the Class B ordinary shares owned by the initial sponsors and management, they also have per share losses for the 3 months ending the 30th of September. 2025, the loss is about 14 cents per share, and for the 9 months, it is a substantial 36 cents loss per share. This highlights the cost carried by the sponsors as they try to find a deal. Let's revisit the class of shares subject to possible redemption. The table on page 12 explains how these shares are accounted for. They are presented at their redemption value outside of shareholders' deficit. This is a really important accounting treatment for SPACs because it recognizes that these shares might have to be bought back for cash. This table shows the reconciliation of those redeemable shares as of the 31st of December 2021. They had over $117 million in redeemable class of shares by the 31st of December 2024, after redemptions and remeasurements due to extensions and other factors. This number had dropped significantly to just over $3.4 million. That seems like a big drop, and it tells us that many original investors have already gotten their money back or are on track to get it back. By the 30th of September 2025, this number stands at almost $15 million, again reflecting the redemption value of those shares. This demonstrates the constant reevaluation of these redeemable shares as the deadline for a business combination approaches. Now let's talk about some of the related party transactions and the money flowing around. The company has a promissory note from Suntone amounting to over $3.6 million as of the 30th of September. 2025, this likely represents funds advanced by the sponsor or its affiliates to help the company meet its obligations or extend its deadline. Then there is the promissory note related party for $1.79 million. This also represents funds borrowed from related parties, probably to finance extensions and operational costs. Interestingly, the company has an administrative services agreement with its sponsor, where it is supposed to pay $10,000 a month for office space and administrative support. However, both the prior sponsor and the current one have waived these payments, which is accounted for as a capital contribution. This essentially means the sponsor is covering these costs themselves. Holders of founder shares and private placement warrants have registration rights. This means they can demand that the company register their shares for resale. This is a standard clause for early investors and sponsors, ensuring they have a path to liquidity. The underwriters are entitled to a deferred fee of over $4 million. This fee is only payable if the company completes a business combination. If not, the underwriters forfeit this significant amount. This is a crucial incentive for the underwriters to help the company find and close a deal. Not required for smaller reporting companies, this is a bit of a shortcut for companies like this one, but it means we get less direct information about potential pitfalls. The company acknowledges that their disclosure controls are not effective. They found two material weaknesses. One relates to the financial statement close process, specifically how investing activities were classified on the cash flow statement. The other is about accounting for complex transactions where a purchase agreement was incorrectly classified. The company states they have remediation planned in place, which involve extra review by the chief financial officer and consultation with experts. This raises a little bit of a flag about the quality of financial reporting accuracy. Importantly, the company states that none of its directors or officers adopted or terminated any Rule 10b5-1 trading arrangements. This is good to see, as it avoids potential insider trading concerns through Arranged trading plans now for my take on Integrated Wellness Acquisition Corp. This company is a classic SPAC story of a company with a lot of cash in trust looking for a business combination to complete. But the numbers here paint a picture of a company burning cash on operational and administrative costs, while waiting for that deal to happen, the significant net losses, and the acknowledgement of control. Deficiencies are definite red flags. However, the interest earned on the trust account offsets some of that spending. The class of shares subject to possible redemption are a huge chunk of their balance sheet. Its redemption value has fluctuated quite a bit, showing the dynamic nature of SPAC accounting as deal deadlines approach. The fact that many shares have already been redeemed suggests that many original investors are either cashing out or that the company has not found a suitable deal within their initial timeframe. The ongoing extensions and reliance on the sponsor for funding through various promissory notes show that the clock is ticking and the company needs to find a business combination. Soon the delisting from the NYSE in late 2024 and trad-ing on the OTC markets is also a significant negative sign. This can reduce liquidity and investor confidence. Ultimately, Integrated Wellness Acquisition Corp is in a race against time. It has significant cash, but also significant operating costs, and the pressure to execute a business combination is immense. The company's direction hinges entirely on the success of finding and closing a deal, which, given the delisting and control issues, seems increasingly challenging. What is your take on these SPAC financials? And what do you think Integrated Wellness Acquisition Corp's future holds? Let us know in the comments below if you found this breakdown helpful. Please give this video a thumbs up and subscribe for more corporate deep dives. Don't forget to join our Discord community linked in the description for even more great discussions. Thanks for watching. See you next time.